When you're young, everyone tells you to take a bunch of risk because you have your whole life ahead of you if it doesn't work out. But no one actually tells you how to go about doing that. So here is the most efficient way to invest in your 20s. So I'd like to start by talking about your mindset. Again, you're young, you have all this time if you fail. You need to be taking as much ball to the wall risk as possible. Ideally calculated risk. You don't want to lose all of your money, but you also don't need to worry that much about safety. You need to welcome volatility. You need to take ferocious amounts of risks. You need to completely forget about bonds. And while I like telling people to just go ahead and invest into a low cost index fund, that is not the way we are going in this video. We don't want to be like everyone else. The point of this is to go straight to the moon. I know it sounds like a Redditor, but we're shooting for the stars here. All right, so now that we've established our mindset and methodology, what do we invest in? Well, first, let me just say this isn't investment advice or financial advice. None of this ever is. I just got to get that out of the way. But we invest in stocks. Why do we invest in stocks? Because they're the most efficient. They're highly liquid. They're very volatile, like I was explaining earlier. All you need is a phone or a computer. You don't have to do a bunch of work with real estate. You don't have to physically go somewhere and buy something and meet someone in person to resell it. You don't have to deal with people at all. And that's what we want. We're not taking the classic low-cost index fund boglehead approach. If you want to get rich, you have to concentrate your portfolio. Charlie Munger and Warren Buffett have both famously said there have been times where they've had 75, 100%, sometimes even over 100% of their portfolio allocated to one thing. I know it's easier said than done, but all you have to do is find 1 to 3 high quality companies that you understand and truly believe in. And not only is this the most efficient way to invest in your 20s, but you can outperform the market this way. Again, at the end of the day, the market is literally just a basket of stocks. And if you want to go the index fund route, use leveraged funds. Again, not financial advice, and no one ever says to use those for long-term growth. But fuck that, bro. If you can make 30% on TQQQ versus 10% on QQQ, why wouldn't you? Obviously, I know if QQQ goes down 10%, then TQQQ is down 30%, but it's the exact same regardless. And so now your stock, not only were you up 30% at one point, which is way more than the regular indexes, but now it's on sale even harder. I literally don't understand why anyone wouldn't do this, except maybe if you were older, and I don't know, maybe I'm missing something here. But especially when you're younger, again, like we said, welcome volatility. I think you can really capitalize on volatility. Some of my favorite stocks have really high betas. But even if you didn't want to use the leveraged ETF route, use like FSELX, for example. I just found out about them recently, but they've been outperforming for God knows how long. I just ran a freaking ChatGPT for total performance of VOO versus QQQ versus FSELX, which was made in 1985. It's a semiconductors fund. And if you invested $10,000 on the inception date of each of these, I believe QQQ was somewhere around 140,000. The S&P was around like 80,000. But if you invested 10,000 into FSELX and reinvested dividends in 1985, you would have $75 million right now. At that point, I do not care about the expense ratio. Okay, so now that we've established that we're extremely risk on and we're only investing in stocks, how do we find good quality companies? You literally just need 3 things aside from some kind of moat: consistent net income growth, share buybacks, and high return on invested capital or return on capital employed consistently. If it's not getting at least 10%, don't even look at the company. We're in our 20s. We have a lot of time ahead of us. You need to only be investing in companies that have at least double-digit earnings per share growth consistently every single year. If it's anything less than 10%, don't even look at it. Of course, there's a lot more that goes into it, and I'll show you that in a second. If you want to use Seeking Alpha or Yahoo Finance, those are both free. You can do a lot of research on there, but I have Qualtrim, so I'm going to show you that. But if we have a revolver with just 3 shots in the chamber, we need to be taking the most efficient shots at the absolute highest quality companies we can. And if it doesn't meet these 3 criteria at a minimum, we don't even worry about the company. So I'm just going to take a look at ASML. This is the largest holding in my portfolio, and it makes up over 15%. Some people might scoff at me at that, but I want even more. So this company, if we take a look at their earnings per share, it is down a little bit recently, but I understand their business model, so I'm not worried about that. But over the long term, they have been crushing that 10% standard that I had. They have been growing extremely fast. Really, all you got to look at is over the long run, is it going up and to the right? And is it doing that at a fairly fast speed? And we can see that with earnings per share. We can see that with revenue. That's what we want as well. So top and bottom lines are both moving up quickly. Free cash flow. Ideally, especially as a dividend investor, you want a lot of free cash flow growth, free cash flow per share, but more cash than debt. Companies with no to low debt have an extremely hard time doing bad. Okay. Peter Lynch once said this, it's really hard for a company to go bankrupt if they have no debt. But this company has way more cash than debt, which is good. And if we move down here to some of the other stuff I was talking about earlier, they buy back shares. That's also good. Why? Well, not only are you not getting diluted, but also since they're actively buying back shares, it pushes their earnings per share up even higher. Also incredibly important, return on capital employed or return on invested capital, whatever you want, at least 10%. Ideally more. Some of the better companies can get around 20. This has been sustaining over 30% return on capital employed over the past 4, and I would assume even during this year 2025. That shows a clear competitive advantage. That shows they are doing something well, and that is a really, really good sign. That's really, really high, and I would imagine their return on invested capital is somewhere similar. And aside from all this, margins are very important. We want at least steady and ideally growing margins. So if we look, their gross margins overall have been pretty steady. Operating margins have been steady and kind of rising a little bit. I need to zoom out a little bit more. So their operating margins have been fairly steady and somewhat rising. Profit margins are pretty much the same thing. Over time, you see it's slow, but it goes up. You only want to invest in monopolies or wide moat companies. Again, ideally, we're trying to have 1, 2, 3 stocks, not that many. So we want to choose the highest quality companies. And the reason why ASML is such a large holding in my portfolio, aside from the fact that it's just expensive, but it's the only company in the world that does what it does. I literally can't think of a bigger moat than that. But they make these EUV lithography machines. Basically, without them, we wouldn't have Tesla, NVIDIA, Intel, Qualcomm, Broadcom, Taiwan Semiconductors. The whole technology space as we know it would just be completely different. It wouldn't be the same at all. And that's why I'm comfortable with having it as such a large position. And that's why I want to buy even more. There are tons of other companies like this, though. Maybe not as wide of a moat, but let's take MasterCard. It shares a duopoly with Visa. Amazing numbers. It doesn't grow every single year perfectly. No company really is, but it has really consistent, really rapid growth across the board. Margins are extremely high, little debt, and they have such a big runway to go. And think, they literally make money pretty much every time someone spends money. That's an incredibly wide moat. They are so deeply entrenched. That is a great high quality company. I only own a little more than 1 share, so not a lot, but I heavily plan on buying more of them. I've just had other opportunities I've been spending my money on. Now, maybe this is hard to sustain over the long term, which is an argument to just dollar cost average into the S&P, but it's something I really believe in, and Terry has been doing this over at Funsmith for years, and he has been absolutely crushing the market. But I don't want you to stop there. So we've gotten our mindset, we figured out what we're going to invest in and how we're going to invest, but that's not the end of the story. Again, we are going for heavy growth with a big risk appetite and a lot of volatility. Where can you get that? Crypto. Now, don't click off of the video. I have been largely skeptical of crypto for a long time, but really, you only need to invest into Bitcoin. Now, you don't have to allocate a large part of your portfolio, maybe like 10 to 15%. You don't have to go like half freaking Bitcoin, half stocks, but it is good to allocate at least some of your portfolio to this because, at least in the case of Bitcoin, let's think about this, right? There's only ever going to be 21 million of them. So supply is already like capped. So there's pretty much infinite upside. And on top of that, it's not linked to the stock market and it's not linked to inflation. Now, maybe I have a little bit of a bias because I've seen a ton of videos about how you just need zero point 0.1 Bitcoin and over the next 5, 10, 15 years, you'll be worth so much money and it'll be like owning a piece of Manhattan right now and blah, blah, blah. But for real, I think Bitcoin is at least somewhat real, I guess you could say, with unlimited upside. And you've seen the growth it has been on over the past freaking 10 years. I don't know. It's ridiculous. I'll link the video that I saw if you want some more information on Bitcoin, but we want to aim to have around 15 to 20% of our portfolio allocated to this. Or if you have another crypto that you really like, you could invest in that too. But Bitcoin has been around the block for a while and it's still here, unlike NFTs and some other things that we've seen come and go throughout the years. But as I was rewatching this video, I realized I kind of worded it wrong almost. We do want to aim to have a very concentrated portfolio with 1 to 3 positions being way more than the rest of the portfolio. That being said, you can still have a decent sized basket of stocks or even invest in an index fund with some of your money, like maybe 30%, and then the rest is split between, 1 to 3 positions. But ideally, you want something that you understand, that you truly believe in, that has a long growth path, and whose fundamentals have been crushing it because I don't care what anyone says, price always follows fundamentals in the long run. This was a very roundabout way of saying invest 80% into stocks and 20% into Bitcoin, but I had to explain my thought process behind it. I hope you got something out of this video. If you did, consider leaving a comment, consider subscribing. I would really appreciate it. Maybe let me know the thought process behind your largest holding as well as how much of your portfolio they actually take up. But good luck on your investing journey.